So today I'm doing my mid-year review. This is Natalie Pace. You are going to be surprised at the top performer. You're not going to be very surprised that silver is way down. The real question is, will it recover and when and why? And will stocks keep going up? And what about the Magnificent Seven, right? Some of them are not doing so well. We also look at blue chips, high yield savings accounts, and even air taxis. So this is going to be at YouTube and Substack, again, Natalie Pace. But I'm also going to encourage you to share it with your friends because it is free. And remember that if you register for our Financial Freedom Retreat by July 31st, you receive $200 off. So you definitely want to do that and join us. These are time-proven strategies, and last year we had 4 super performers, and we've been able to help people earn a good steady yield with no paper losses. Time-proven strategies since 1999 change the game. So please tell your friends to join us as well. All right. Great. So let's take a look at the performance. And again, I do think that you are going to be a little bit surprised at the top performer. Because even though we've been hearing so much about oil prices, obviously for obvious reasons, and we can talk more about that in just a moment, clean energy was the top performer. Now, a lot of people were not expecting this because, of course, the United States has stripped all of the incentives for clean energy. But what we're not factoring in is that AI and data centers use a ton of energy. They are scrambling to get energy, and yet a lot of these companies have net zero goals. And so they're having to meet a lot of these, their new energy demands with clean energy. So that has got clean energy super performing. It was a big performer last year too, a big surprise breakout. So just as a reminder, you want to make sure that you've got 4 hot slices, and I will be talking about that in just a moment. Now, no surprise that some of the worst performers this year are silver and gold, but I think it is a bit, and crypto, but I think it is a bit surprising that we have so many Magnificent Seven companies that are either underperforming or going down. So Meta, Microsoft, all went down in value, as did Tesla. Nvidia is not a super performer this year. The S&P 500 is up 9.2%, 5% for Nvidia, or less than 5% for Nvidia. Of course, Google is still a superstar, and Apple's doing pretty well as well. So these are all doing well. And the big question is, will silver and gold recover? Will we endure a crypto winter? Will that continue? And where are stocks headed? So a lot of analysts are saying they believe that stocks could go up 16%. It's already up 9.2%. So that means that it could still go up by the end of the year. Um, Look, there are a couple of more than a couple of things that are of concern that could cause that not to happen. One is it's the midterm election year, and that is not a good cycle. So in 2022, stocks lost almost 20%. That was the S&P 500 drop, but the Magnificent Seven dropped tremendously. Tesla was down 67%. Nvidia was down by half. So most of them were down in between 35 to 67%. Now, it's not because these are not good companies. It's because they are extremely expensive. So, and a lot of it is done through margin trading and borrowing and all of that. So when we start to see an economy slow down, those go way down just because of the price of them. That's not the case, and not what happens with gold, silver, and crypto. And we will be talking about that in a moment. But that's really the story. It's not that NVIDIA isn't great or we aren't all starting to learn how to use AI, which we are. It is that it's very expensive. So that's something to think about. We have ways of capturing gains and monitoring that so that we can still stay on the right side of the trade, whether stocks go up or down. So there's always going to be a lot of uncertainty in any forecasting because there's just too many variables that go in. In fact, having high oil prices or war continuing is very negative for stocks continuing to go up. And that's why you saw a big drop in today in the market trading because nobody was excited about the war continuing and more problems in the strait. So I'm going to take you over into my PowerPoint presentation. So I am going to be going on the Money Show tomorrow and talking about this, but I I talk about a lot of things that I think are important for our mid-year review in here. So I'm going to share with you a lot of it. So crypto is plunging. Private credit companies are actually gating withdrawals. There's been a deep fake Buffett video that's been circulating, ultra high yield offers on YouTube and by email for both savings accounts, but also oil and gas opportunities and real estate opportunities. And we're going to talk about all of those. So silver and Peru were the superstars of 2025, followed by gold, Magnificent Seven, and clean energy. So I did want to remind you of that because we used a lot of these for either our value replacement funds and or our hot slices. And we always encourage everybody to rebalance at least once a year. So you're going to always receive a rebalancing email or a big blog about me saying, hey, rebalance, or an Instagram post at the end of every single year because it's a great time to do it after a Santa rally. After the spring rally is another great time to rebalance. So now is a good time because stocks are still trading very close to their all-time highs. So this helps us to have a capture gains instead of just riding a Wall Street roller coaster. So if we had a hot slice of silver, and it almost tripled last year. So the first majestic silver one did go up more than triple, it quadrupled. So if you are going into these kinds of hot slices and you see one hot slice has become three at your rebalancing, sell two and keep one. And that way, if it goes down, instead of losing, half or going back to where you started, you actually are keeping the money, and then if your slice gets smaller, you can buy more at a lower price, assuming you still think it's hot. Now, we'll talk about whether or not we think gold, silver are still going to be hot and what's going to happen with um, cryptocurrency, as well as Magnificent Seven clean energy. But the same holds true with Magnificent Seven because like if you're tech B, you wanted to have tech B, or even another one that's been swirling around a lot is cybersecurity. So the capture gains strategy of the rebalancing it once, twice, or three times a year is really what's going to be helpful for you, right? So you can see here that cybersecurity was a bit of a bargain this time last year. And again, if you had that hot slice mentality or you were dollar cost averaging, now you're probably going to in a position to start capturing gains at pretty much an all-time high, right? Tech B is the one that has a lot of the Magnificent Seven. It's the breakthrough multi-sector on iShares. And again, this is another one that's trading at an all-time high. So just understanding that can help us to start capturing gains. So Bitcoin, and this is from last year's all-time high. Bitcoin is down by half. Silver is as well, and gold is down 26.5%. It's a poster child for capturing gains, even when it's something you love. And this is more important than thinking about what the economy is going to do or how I feel about it. Right? So every time when you are doing your rebalancing, mock up a pie chart of what you have, mock up a pie chart, age appropriate, properly diversified of what you should have. And if your slices are bigger than what they should be, it's screaming at you to capture gains and sell high. If it's smaller, if you still think it's hot, then it's telling you, hey, now is probably a good time to buy low. So this system is a buy low, sell high system on autopilot, and it is designed to help keep you on the right side of the trade, which is key when you have things like this happening. Now, in terms of where things are headed, I am going to talk a little bit more about silver and gold in just a moment. I'll show you the analyst projections on it. On Bitcoin, it is really highly correlated with the Bitcoin halving cycle. The next one doesn't happen until probably April of 2028. It's not an exact date, it does move around, but and what we typically see is the last halving date was in 2024, The year after the halving date, it's when Bitcoin hits an all-time high. And in the second year is when it hits its crypto winter that can last for about 18 to 24 months. So if it goes to schedule or to script, then crypto could remain a weaker performer. It could even go down and then maybe start its recovery this time in 2027. So I would just be very cautious about crypto right now. So rebalancing, we just talked about this, capture gains at least once a year. The end of the spring rally and the Santa rallies are great times. If you missed the end of the spring rally, now is a great time because stocks are still trading very close to an all-time high. So again, this is what an age-appropriate diversified plan that's actually overweighting safe based on market conditions looks like. And you can personalize your own pie chart using our free web app. Just email info@nataliepace.com and we're happy to send that over to you. If you know what you own and you know exactly what you should own for an age-appropriate, properly diversified plan, then you're always going to be, capturing gains, earning income safely, and protecting your wealth. Because as we get closer to retirement or in retirement, we just can't afford to keep riding the Wall Street roller coaster. It is better gains in the bull markets, but it is devastating in bear markets, and it can take a great deal of time to make up the losses in a recession. So, and during that time, your FICO score is down and you don't have any liquidity, you can't buy low. There's all kinds of other problems that happen when you don't keep enough safe. So, if you haven't ever done this and know exactly what you own in that pie chart format where everything is allocated into small, medium, large value growth and maybe four HOTS, then I can help you with that in private coaching. But it's important to know what you own and be the boss of your money now. So again, you can get safe, hot, and protected in one easy plan, but you got to know what you own to do it in order to be the boss of your money. So again, this is the performance year to date. As I mentioned, clean energy top performer, followed by energy. And then we have some industrials in there. And our Magnificent Seven, many of them are underperforming or losing money. And then, of course, some of our weakest ones are gold and silver, and certainly Bitcoin and Ethereum. So why did six of the Magnificent Seven lag behind the S&P 500, which is up 9.2% year to date, with three losers in the bunch? And why is clean energy the hottest sector? Why are gold and silver down? So it's actually five out of the seven that lagged behind the S&P 500. And again, it's a different story with Tesla, but with the other ones, it's just a question of price. With Tesla, in addition to it being very expensive, the price wars for electric vehicles, and it's still mostly an electric vehicle company, definitely the majority of the revenue is from electric vehicles, has forced Tesla to lower prices. That's less revenue per year over year. And that's less profit margin. So as just a brief example, 2 years ago, Tesla's net profit was 15 billion. It was under 5 billion in 2025. So this is a different story than what's going on. The other Magnificent Seven companies have year-over-year sales growth that's really good, and they have very healthy profit margins, with the exception of Amazon. And they're just very expensive. So that's why the price swirls around so much. Now, with regard to gold and silver, again, they got very lofty, and we just saw some capture gain strategies honestly. The trajectory for gold and silver is still strong, unless we have a lot of interest rate hikes. So then we can start seeing people that will go move into bonds and say, hey, I can go there and I have a good yield, because gold and silver don't give you any income, right? It's just all capital gains. So there are a few moving parts as to whether or not gold or silver will go up or down, but I will show you what the analysts think. So right now, let's see where gold and silver are. Let me go ahead and put it up on the exact today. So I can just go, I'm using MSN, right? And gold is at 4,000 and change, almost 41, and silver is way down, right? 59. So if we go back now, 41.59, most of them are saying that gold's going to go up pretty high. Not maybe not back to its all-time high, but pretty high. And that silver's going to go up as well. Again, maybe not to its all-time high, but still up. And this is based on silver going up is based on not just that it's a companion to gold and a precious metal and a safe haven-ish. I say ish because people always say, oh, it never goes down in value. That is not true. You just saw that this, the difference between 6 months, it does go down in value. And sometimes when it goes down in value, it stays there for a very extended time. So that's why we don't just put all of our money into crypto or Bitcoin or gold or silver. It's a hot slice so that when it really goes up, we capture gains. And when it really goes down, we can buy more low if we still think that the trajectory is strong for it. So I would say that, it still looks good, right? There are many reasons why it could still go up. Now, if stocks start to go down, then it will drag gold and silver down initially. And then if they continue to go down, then there will become a decoupling point where people start moving more into precious metals. They're really disgusted with the losses in their stocks. We've seen this in many recessions. So, do you have performance in your plan? Should you have a hot slice of silver and gold or Bitcoin, coins or ETFs, right? Will rising interest rates lure investors to bonds? Will debt concerns attract them over to precious metals? And will the crypto winter freeze over for another 12 months? So, yes, we talked about most of those things already. Now, if you have a hot slice of silver and gold, again, if you have the coins, the issue is this, that if you sell them, you are going to pay capital gains taxes, and they can be pretty high. So I know people when, silver was at its all-time high, private clients, and I was like, they have a big chunk of silver and it was worth a lot of money. And they were like, oh, I don't want to sell it because of the capital gains. I'm going to wait. And now, of course, they could have sold. Again, it's not all or nothing, right? It's just having it more in a diversified plan. But they could have sold and paid the capital gains and still had a boatload more money than they have right now. And that's the issue. So a lot of times if you, it's one of the reasons why I say, especially if you have kids or if it's you and you're at your job, don't put all your money in your 401k. Put it in a Roth IRA too, if you can, or a traditional or a SEP. And that way, one that you can self-direct so that you can actually do silver or gold within your tax protected retirement account where you do not pay capital gains taxes. So I think that's an important thing. You can also do that with crypto, only Bitcoin and Ethereum. But this is an important thing to think about when you're thinking about whether you want a fund or a coin. Now, alternative investments, so whether it's precious metals or private equity or private debt or real estate, are volatile. They have aggressive and cheap email and social media ad campaigns, and a capture gains and diversify mindset are key. So be cautious because what we do see with Bitcoin and precious metals a lot is that if you've been worried about this or that, whether it's politics, or the economy, then you're going to be targeted. Very aggressive gold and silver people that want to sell you coins that they make a lot of money on it, or salesmen that make a lot of commission on it. And they're going to try to scare you because they already know that you are a person that's going to be responding to that. And I have seen people go all in and then lose a lot of money. So just be very cautious of anything that you see on YouTube or by email or on social media because it's a paid ad and they can be very aggressive and they don't tell you all the truth. So again, strongly encouraging you to put whatever you think is hot into a slice format instead of all or nothing. Now, private credit funds have started to gate withdrawals. They can be illiquid. They can have junk bonds in there, and they can also experience paper losses. So what we have seen is Owl Capital had started gating their what does that mean? If you wanted your money back because you thought they were getting in trouble, they say, sorry, you can't have it back right now. where it's this called a gate. So I think you should just be always cautious of these kinds of things. They kind of lure you in saying, oh, we did this amount of capital gains, including our yield and our growth and all of this stuff. And yeah, you're just going to invest for the long term. And that's the way people are kind of sold in. And then when you read the fine print, it will say in there very boldly and plainly, look, you only 10% of the people can actually get their money out. These shares are illiquid. That will also say we invest in junk bonds. You shouldn't expect that you make any money on this. I'm going to show you one of the funds. Of course, they bury it at the bottom or in some sort of disclaimer thing, but this is the BCRED one that was offered by Blackstone. And one of my private clients had it. And I was like, why in the world did you let someone sell you into this? But of course, at the top, it looks very interesting. And then at the bottom, very, very bottom, that's where you're going to see all of the disclaimers that you really should be reading. So I think that's another thing is that you must read the fine print. Private equity LLCs. These are LLCs that are not publicly traded, which means that you must do 100 times the due diligence. They lure you in with high interest. They bait you with hot interest. They and what do I mean by that? They'll say, "Hey, you're going to be able to make 9 to 13% by owning an oil and gas company." First of all, you do not own the oil and gas company. You own stock in the company that is saying they are either exploring or own the oil and gas company. So you own stock, not the physical company. Also, what a lot of these, not just this one in particular I'm thinking of, which I can't say because every time someone names him and mentions that he has a felony, he sues them. So I can't say this one person, which is all over YouTube right now for 9 to 13% interest. And what they do is they tell you, hey, you shouldn't get cash. You should actually just let that interest roll over into another bond. And so they actually aren't having to pay out very much in interest because that's how they're luring people in. So I would just say, and I'm going to go to a little bit more here. Do they actually have experience running companies? Now, this particular one that I'm thinking of, the mother and the father were actually in the oil and gas industry, but they didn't run the company. He hasn't ever run a company. In fact, the one that he ran before that got into serious trouble, and he has a felony against him, and he's involved in multiple lawsuits. So, in terms of C-suite experience, you're not, you can't compare this person to, former Steve Jobs or even Elon Musk, who's able to run multiple companies at the same time and do quite well with them. That this is not this person. Um, when do you get your money back? So we're seeing this again, they're saying it for real estate or oil and gas. They might say it for real estate, they might say it for storage units or something that you think is really stable. But I want to tell you, you should read the D&T blog, and I'm going to include it in the description, the link to it, so that you can do that. And this is a couple that were sold into a real estate opportunity that paid them high yield. And they actually lost $18,000. Now, they could not afford to do that. The person that sold that to them made over $8,000. So a lot of times these private equities are paying the salesman a really sweet commission. So I will include that so that you can read it in their own words about their experience. But basically, when the person is trying to sell you, you get a lot of calls. When you want to get out, they don't return the call. So this is private equity is really a dangerous, dangerous place. Be very careful. So again, this is the particular one I'm telling you about, which I can't tell you the name of it. Oil and gas one, popular on YouTube, offers 9 to 13% interest, family-owned business, CEO with a felony conviction that he doesn't want you to know about. Payments are in kind, so they roll them back into more bonds instead of giving you cash. Truly, running an oil and gas business is hard. There were 107 bankruptcies in 2020, 142 in 2016. Even today, with oil prices high, Oil and gas companies are concerned about that because they know if the prices stay too high, we'll hit a recession and then everybody will stop traveling and driving and their oil prices are going to go down again. In the Great Recession, I mean, in the pandemic, oil prices went negative. So it's pretty important to understand, that at the end of the day, you need to know that this person can actually run the business that you are investing in. So grade your guru before you listen to anything that he or she says. And that means a lot of due diligence, right? On the deepfake Warren Buffett video, real estate and dividend stocks were recommended for the income. Now, look, we like income too, but is this something that Warren Buffett would say, the things that they were talking about? And he did a CNBC interview with Becky Quick in May of this year. And he said that stock prices are silly and sometimes you do nothing. In fact, Berkshire Hathaway has record amount of cash that's in short-term treasury bills. So we have a strategy, which I'll be kind of outlining a little bit of it towards the end of this, about what you should be thinking about on the safe side, right? But again, we like income. So I'm not saying that every single thing in that deepfake video was wrong. Income is good, but the ways that they were telling you to get income, you could experience capital loss, paper losses, and a lot of other problems. So please, please, please don't fall for deepfake videos. Warren Buffett very famously doesn't do a lot of interviews and doesn't do commencement speeches or anything. So 4% on $1 million is $40,000 annually. This is great, right? So income without paper losses is what we're really looking for. And one of the things that we're doing in terms of income on the dividends and stocks is we are using value replacement funds because there is a lot of debt and leverage in the United States, and the amount that you make in your dividend is not that high. If you are getting a high dividend, then it's really risky. Like maybe Ford is offering a high dividend, but one of the rating agencies has it as a junk bond still, and the other two have it at the lowest rung of investment grade. So the higher the dividend, the higher the risk should be the mantra. That is another blog that I think you should read, and that's the current blog on nataliepace.com. I'll put a link in there in the description of this as well for you. So again, we're using value replacement funds, and not only is Peru paying above what the comparable S&P 500 fund would pay you in dividends, it doubled in value last year. So important income mantras are never reach for yield. The higher the dividend, the higher the risk, and be more concerned with the return of your money than the return on your money. Fixed income strategies are keep the term short, keep the credit worthiness high, lean into newer companies, underweight older companies, observe FDIC and SIPC insurance level, and know the fine print and risks. So again, the 1 year return for gold was spectacular. You definitely want a hot slice of gold. And even in 2022, when things were really bad and bonds were worse, so that fixed income side, the one that's not supposed to lose money, was the biggest loser. You have to be very careful, right? Gold did well. Another thing, real estate did better, right? So I want to remind everybody that hard assets can hold their value when we hit a recession, when paper assets start going down. So here's something I told you about the other midterm election year, 2022. 2018 was a midterm election year. It was also a down year, about 6% down in the S&P. And what you'll see here is that silver actually did hold its value. Gold held its value better. Tesla way down. The ARK Innovation Fund with a lot of the Magnificent Seven way down. And obviously long-term government bonds less even more than the S&P 500. So remember the rule of 72, because if you're trying to get into an annuity, because it's saying, hey, you won't lose money. First of all, that's not true because the minute you buy it, you lose access to up to 9%, maybe even 10% of your principal for up to 10 years. That's a loss, right? And it could take you 36 years to double your money at a 2% return, which is what a lot of the annuities I've looked at have been paying. This is another thing you need to know about. Wall Street has a gambling problem, and margin trading can snowball. It adds volatility. 2022 happened after the post-COVID peak of margin trading. 2020, it was a real rapid drop at the beginning of the pandemic. We saw S&P 500 drop 35% between February 19th and March 23rd. So this is the other peak was right before the Great Recession, right before the dot-com recession. So those are some of the things that I talk about when I say that there are concerns out there that it's not a guarantee that stocks keep going up. So again, this is your best protection is to make sure you have an age-appropriate, properly diversified plan. And if you are worried about margin trading or the amount of leverage and debt or anything or the war, then overweight a little safe. It's not all, it's not nothing. So it's easy to make a lot of money in a bull market and easy to lose money in a bear market. And don't confuse a bull market with wisdom. The stocks are very expensive. The only time when it was more expensive than today was the dot-com recession. So this is where we are right now, this 40, and here's the dot-com. Here's the Great Depression. Stocks are more expensive today than they were there in 1929. So if you would like this asset or debt bubble, obviously I'm recording this so you can watch it back. That's our financial freedom retreat. Remember to tell your friends they can register by July 31st and save $200. And we're having a bonds and fixed income without paper losses masterclass this Saturday afterwards. Now, you do need to attend the retreat in order to attend that class because you need the information. We spend one full day on bonds and fixed income and what's safe and how to get safe and how to earn a safe income without paper losses. One full day at the retreat. And then the bond master class will take it even deeper. So again, if you want to personalize your own sample pie chart with our free web apps, email info@nataliepace.com. We'll send you the link. And we'll be on the Money Show tomorrow talking about a lot of the things that you just saw today. Rebalancing is key. Dollar cost averaging, if you don't have it, get safe, hot, protected, and one easy plan. And again, all of this is covered in our financial freedom retreat. Okay, I did promise you that I would talk also about air taxis. So air taxis are basically disrupting the helicopter space. They are electric, kind of like flying cars, but again, as one example, one of the ones, Joby, actually purchased a helicopter company, and they're just using the helicopter, airways, right? In the LA area, the other competitor, Archer Aviation, which is the official air taxi for the LA Olympics, what they did is they purchased an airport in Torrance so that they have a great landing pad from which to go out. So again, they've got kind of a cool thing because they're disrupting an existing air traffic industry, and they are expected to start flying in 2026. Also, the prices are pretty low. Joby has got a higher price than Archer does, but we'll take a look at both of them. So again, I'm going to put these links in the description section. Here's the links to Archer and the overview about what it is that they're doing. And they are expected to start flying in 2026. They only have one more phase to go on their FAA certification for EVTOLs. And then here was Joby, which was able to do actual test flights for 10 days between Manhattan and JFK, and they were able to do it in under 10 minutes, which is obviously going to be something that's very exciting for folks. Now, when we think about the share price, again, we can look at Archer, and it's not had, a lot more interest in Joby right now than there is in Archer, mainly because Joby has, been doing those exciting things that they have a lot of newsworthy accounts on, like the trips in Manhattan. So this is trading for a very low price, whereas Joby, Oh, Joby is still trading pretty low too. A 52-week low. So again, if when the interesting thing is that everybody will be very excited when we start seeing people, actually flying in air taxis between Manhattan and JFK or around for the Olympics or any of this stuff. And by then they could be shooting the moon. Now, this is Vegas money. It is definitely, I do own them, full disclosure. I own Archer, not Joby. And it's not nest egg, it's not money while you sleep. But I do think it's a very exciting, disruptive industry to keep an eye on. Now, the other thing I wanted to tell you guys about, again, here's the blog on the Warren Buffett's investing tips. I do encourage you to read that. Here's the one on Wall Street's serious gambling problem. I do definitely, it's about the margin trading being at an all-time high. And also the new one about the higher the dividend, the higher the risk. And it really discusses all the private equity things that we talked about. In terms of copper, I wanted to just talk about this because Peru has still been a superstar and copper is still really on fire. Okay, so one other thing I want to just say is again, Financial Freedom Retreat. If you click on the flyer on the homepage at nataliepace.com, you can read testimonials. You can learn the 15 plus things that you'll learn at the retreat. It does take a while. Like you shouldn't expect that in one weekend you can speak French. And if you haven't ever learned the life math that we all should have received in high school, a lot of people do a 12-month all access pass for that reason. They're getting 4 master classes throughout the year, and they are also getting 4 retreats, which just keep pushing you up the path to wisdom. I remember when I first started reading Shakespeare, I understood about 1 out of every 7 words, maybe. And now I can read it, and it's a joy for me. So, just have grace with yourself that it does take time, and then it becomes this massively solid financial foundation, not just for you. Think about it for your kids as well and if you have grandkids. Also, we do have a free video coaching program, and this is daily mantras that can help you and also remind you of various strategies that can be game changers in both the Thrive budget, where you could literally save thousands, if not tens of thousands annually, and also investing so that you can start increasing your wealth and keeping it. So again, nataliepace.com, and do follow me on social media because that's where you're going to get notification of all of my new blogs and other ways that you can interact. So thanks again, and I'll see you soon and have a wonderful summer.